Okay, let's dive into this. So, right now, in early August 2026, the global oil markets are caught in this massive paradox. On one hand, we've got a conflict that's been raging for over 5 months, snarling one of the world's absolute most critical transit routes. But on the other hand, oil prices are actually dropping, and that's offering a sudden, huge wave of relief to inflation-weary economies all over the globe. Welcome to The Explainer. Today, we're breaking down the intricate, high-stakes negotiations over the Strait of Hormuz and uncovering exactly why just the whispers of a peace deal are sending shockwaves through everything from global crude benchmarks to your local gas pump. To make sense of all this, here's our roadmap. First, the oil price roller coaster. Then, the Strait of Hormuz. Next up, the inflation connection, followed by market winners and losers. And finally, we'll hit the remaining risks that could flip this entire situation completely upside down. All right, part one, the oil price roller coaster and why Brent crude is dropping. Earlier this summer, Brent crude, which is the big international benchmark for oil prices, pushed dangerously close to $100 a barrel, and that sparked a lot of widespread concern. But recently, a highly specific number has totally taken over the market: $3. Literally, we're seeing these massive, sudden, daily price spikes and drops of more than $3 a barrel. It's a literal roller coaster, and it's being driven entirely by headlines and rapid-fire rumors of a potential transit deal between Iran and Oman. When officials signal a temporary deal is close, crude aggressively sells off. But the second those details look fragile, or when Iran reviews restrictive legislation regarding vessel access, prices bounce right back up, just whipping traders back and forth, day after day. But hey, despite all that daily turbulence, the broader trend is actually pointing downward. Both Brent and U.S. crude tracked 8 to 9% weekly losses at points during early August. What this tells us is that traders are actively pricing out fear. They're betting that a workable transit arrangement is on the horizon, which effectively strips away the geopolitical risk premium. That invisible fear-based surcharge that inflated oil prices for much of 2026. The market is basically taking a deep breath and deciding that the absolute worst-case scenarios might just be off the table, at least for now. Moving on to part two. The Strait of Hormuz, a true global choke point. And the physical geography here brilliantly explains this massive market shift. To truly understand why the whole world cares so much about this one specific area, we just have to look at the math. A full 20% of global supply relies entirely on the Strait of Hormuz. Before the conflict erupted at the end of February, roughly 1/5 of the world's oil flowed through this single narrow waterway between Iran and Oman. It's the primary exit route for crude coming from Saudi Arabia, Iraq, the United Arab Emirates, Kuwait, and Iran itself, along with massive amounts of Qatari LNG. It is, without a doubt, the world's most important energy choke point. So when the fighting intensified between the United States, Israel, and Iran, tanker traffic through that choke point basically collapsed overnight. Millions of barrels of oil became completely stranded inside the Gulf. Now, alternative routes do exist, like Saudi Arabia's massive pipelines running to the Red Sea and UAE facilities cleverly positioned just outside the strait, and they certainly helped mitigate some of the damage, but they simply can't fully replace the lost volumes. That massive physical bottleneck is exactly what caused those initial panic-inducing price spikes earlier in the year. The plumbing of the global energy system was fundamentally blocked. So, what exactly is holding up the fix? Well, it boils down to competing financial and transit fee structures for establishing new designated shipping lanes. Reports show Iran has sought service fees in the range of 5 to 7% of a cargo's total value. Oman, stepping in to try and mediate, has discussed lower figures, hovering right around 3%. Meanwhile, Washington has publicly favored a completely fee-free arrangement to keep global commerce unhindered. When you add in the complex practical obstacles of existing U.S. sanctions and really stringent insurance restrictions that complicate how any payment mechanism would actually work, you can see exactly why negotiations are grinding and stalling. We've been talking a lot about geopolitical choke points and intense international negotiations, but I know what you might be thinking. What does this actually mean for your wallet? Why should you, as an everyday consumer, care about a shipping lane agreement happening thousands of miles away? Let's get into it in part three. The inflation connection, focusing on energy costs and the CPI. It really works like a direct chain reaction. Step 1, crude costs drop due to market optimism. Step 2, because energy powers literally everything in the modern world, that sustained decline makes gasoline, diesel, and raw manufacturing noticeably cheaper. Step 3, consumer prices finally cool down. The cost to produce, package, and ship that new air fryer you just bought online, it goes down, easing the daily financial pressure on households and businesses everywhere. Cheaper oil is basically a massive global tax cut for consumers. Which actually brings us to a highly critical data point for the U.S. economy right now, negative 23,000. That is the net loss of jobs from the unexpectedly weak U.S. July payroll report. The Federal Reserve has been fighting sticky inflation for years with high interest rates, but this cooling labor market was a glaring signal that the broader economy was finally hitting the brakes. It showed us that businesses were pulling back on hiring as borrowing costs squeezed their margins. When you combine that weak jobs data with rapidly falling oil prices, it drastically lowers the odds of a renewed energy-driven inflation spike. And as a result, it reduces the probability that the Federal Reserve will raise interest rates in September. This gives the Fed some incredibly valuable breathing room to navigate a soft landing for the economy. And hey, it's not just the US either. Cheaper energy eases massive economic pressures in Europe, Asia, and oil-importing emerging markets all around the world. It reduces their need for aggressive monetary tightening and improves their national current account balances. The relief is truly global. Which leads us to part 4, market winners and losers, and this massive asset repricing. So the crucial point here is how all these macroeconomic shifts are just aggressively repricing global assets. The divide is incredibly clear. In the beneficiaries column, tech and growth stocks are surging because their future earnings look way more attractive with lower interest rate expectations. Airlines, refiners, and energy-intensive industrial companies are winning big too, thanks to their drastically lower fuel input costs. This broad, risk-on mood has even helped push the S&P 500 into fresh record territory. Bond markets are happy as well, with longer duration treasuries seeing solid support. Now, for the underperformers. Integrated energy majors and pure-play exploration and production companies, the businesses actually digging the oil out of the ground, they are taking a significant hit as crude declines. The US dollar has weakened as rate differentials narrow. And gold? Well, it's in a pretty complex spot. Lower real yields usually help gold, but a strong overall market appetite for risk can actually reduce demand for safe haven assets like precious metals. Finally, part 5, the remaining risks to diplomatic progress. All right, before we break out the confetti, let's bring this back down to earth for a second. There are 4 stark realities blocking a quick fix here. First up, incomplete diplomacy. Previous ceasefires have collapsed before. Iranian officials continue to assert sovereign control over the straits, while U.S. officials steadfastly resist formalizing that role. Second, logistics. Even with a signed, perfectly structured deal, physically demonning the waters, securing complex maritime insurance, and convincing cautious ship owners that it's actually safe takes a considerable amount of time. Third, structural supply. Outside the Middle East, OPEC plus production policy, U.S. shale responsiveness, and broader Chinese demand still completely dictate the medium-term market balances. And fourth, independent geopolitical flare-ups, like Houthi activity in the Red Sea, which can easily support high oil prices regardless of what happens with the Hormuz negotiations. And listen, it's also absolutely vital to remember that global commercial oil inventories have been heavily drawn down during this disruption. What that means is that even if a transit deal gets signed tomorrow, it wouldn't immediately create a massive oil glut. The global market is still structurally tight in the near term. This essentially ensures that residual risk premiums are going to persist for quite a while, acting as a firm floor underneath oil prices, even on good news days. Which really leaves us with this one final profound question. Is this the dawn of energy stability, or are we merely looking at the calm before the next storm? The direction of travel in crude right now is undoubtedly giving the global economy a much-needed moment to breathe. But as we've seen, until tanker traffic permanently normalizes, the delicate balance between optimistic hope and actual on-the-ground delivery is fragile enough to move oil several dollars in a single afternoon. Keep your eyes on the Gulf because this story is far from over. Thanks for joining this explainer. Keep questioning the headlines, and we'll see you next time.